Hello and welcome to auditing. Today we're going to be talking about auditing. And I realize some of you have seen this in college. Some of you may have never seen it, but that's fine because I'm going to teach you what you need to know to get you through the CPA exam. My name is Roger Phillip. Also, make sure you watch the intro because in the intro, I'll introduce myself, but also talk about the course, the exam itself, and a good study program and study schedule to enable you to get through the CPA exam. So very important, make sure you watch that. What are we starting out with? We're starting out with audit standards and engagement planning. So what we're looking at here is we're going to perform an audit on a client. Now we're going to talk about different types of audits in a moment, about a compliance audit, an operational audit, a financial statement audit, for example. But what we're looking at here is mainly the financial statement audit. Now, in this type of audit, which I'll come back to, we're looking at these financial statements. What I want you to realize for auditing, I don't want you to memorize stuff, but I want you to understand it. And as you'll see in the next 25, 30 hours, I'm going to walk you through it step by step to make sure you understand auditing. With auditing, we're looking at these financial statements. These are management's financial statements. Management is responsible for the preparation. Management is responsible for the fair presentation of the statements, the preparation and presentation. Our job as an auditor, should we decide to accept it, is to obtain sufficient, appropriate audit evidence in order to afford us a reasonable basis for giving an opinion on these financial statements. So our job is to give an opinion on these statements. In our opinion, the statements referred to above presents fairly in all material respects. So what we're saying is, in my opinion, the numbers are presented fairly. So what we're doing here in auditing, there's a lot of overlap from, for example, your favorite intermediate accounting class. Because in intermediate accounting, we talked about things like cash, receivables, inventory, accounts payable, notes payable, and so on. Here in auditing, we're talking about not necessarily how to prepare the valuation in the FAR exam, but here what we're looking at is how do you audit that? How do I obtain enough good evidence so I can give an opinion on these numbers? Because investors rely on these numbers, creditors rely on these numbers, people look at these statements. They rely on our opinion in order to make a financial investment in the company. Therefore, it's imperative that we're objective, unbiased, independent, clear mental attitude, all of this stuff that we'll talk about in just a few minutes. But the big picture of auditing is that, for example, we'll talk down the road, but when we're looking at these statements, there are certain assertions. For example, PERCV, perceive. These are some of the assertions management makes in the form of financial statements. For example, management is asserting that all these numbers are properly presented, adequately disclosed, they exist, rights, they own them, completeness, cutoff, valuation, allocation, accuracy, classification. So these are some of the things that they're asserting. So management is saying, hey, in these statements, in these numbers, and for the next 25 hours when I say whose statements are these, to stay awake, I want you to go, management! Old air out, fresh oxygen in, brain cells start cranking, stay awake, you learn, you pass the exam, become a CPA, find out what true happiness really is. All right, I'm so excited. So this is what management is asserting, and I'll actually teach you, you perceive. So understandability and classification, presentation and disclosure, existence and occurrence, rights and obligations, completeness, cutoff, value, allocation, valuation, accuracy. These are the assertions. So for example, when you think back on your intermediate accounting, accounts receivable should be valued in the balance sheet at how much? Their NRV, which stands for net realizable value. Net realizable value is the amount you expect to receive within 1 year or the accounting cycle, whichever is longer. Inventory should be at the lower of cost or market, LCM. So what we have to do as an auditor is in the financial exam in FAR, you're going through and calculating the valuation. You've got to value receivables at their NRV. You've got to go through and come up with bad debt expense, percentage of credit sales, aging of AR, and so on. So we're looking at the dollars. Here in audit, we're looking at making sure that receivables exist. It's the company's receivable. They're the proper amount at the NRV. They're complete. They're classified properly. If you factor, discount, pledge these receivables as collateral for a loan, that has to be disclosed here in the statements. So again, in financial accounting, we care about the dollars. Here in auditing, we care about giving an opinion that, in my opinion, the numbers are presented fairly in all material respects. That's what we're trying to do here. So keep the big picture in mind. Don't get lost in the minutia, in the detail, but keep the big picture in mind. So as we go through here with inventory, or even receivables, we're going to talk about confirmations, positive confirmations, negative confirmations, blank confirmations, and so on. So in financial accounting, we look at dollars. Here in auditing, we're trying to make sure that these numbers are you perceive, understandable, presentation, and so on. So I'll give you a mnemonic memory aid, you perceive. I'll give you another one, race. So we'll go through all of these, and it'll help you to kind of see the big picture and understand what it is that we're trying to do. As we're going through this, we're trying to obtain something I'll introduce to you in a minute called reasonable assurance. So when we're going through and doing an audit, we don't need what we call absolute assurance. I don't need to make sure that every single account receivable is perfect. But what I have to do is set a level of materiality and say, okay, everything above that level I'm going to look at, everything below that I'm not. That way I can go out and obtain what we call reasonable versus absolute assurance. So as we go through this, the main focus of the course is on what we call a financial statement audit, where we're trying to give an opinion on these numbers. We'll also talk about a few other types of audits along the way as well. Okay? Starting out in your notes, says here 3 basic types of audits. We have a compliance audit, operational audit, and a financial statement audit. So as we look at this, over here I'll put a compliance audit, an operational audit, and a financial statement audit. So compliance, operational, and then again financial statement. This is the main focus of the exam. So with a compliance audit, what we're trying to do is to see if the company is in compliance with laws, regulations, an IRS audit, rules and regulations. Are they in compliance with the covenants of a loan agreement? Let's say, for example, they borrowed money and they owe it in 5 years. That's great. So it's presented as long-term debt. But they violated some of the provisions of the loan agreement there's positive covenants, negative covenants we'll talk about in the BEC exam, but they violated something, which means that loan is callable today. What does that mean? It means it goes from long-term debt to short-term debt. What does that do to all your ratios? It messes them up. Working capital, current ratio, quick asset, and so on. So all these ratios change dramatically. That's called analytical procedures, the study of data comparisons and relationships. So all of a sudden, these numbers change. So what that means is that debt that they said was long-term is not properly presented or classified, because they classified it as long-term, but it's really short-term. So that's where we're going out, for example, and doing a compliance audit to see, are they in compliance? So if you look in your notes, you'll see here, IRS audits governmental units to determine compliance with laws and regulations. CPA to determine compliance with provisions of a bond or note agreement. We'll talk about special purpose frameworks as well. That deals with what we call compliance laws and regulations. We'll also talk about this as well with international auditing standards, because they're concerned a lot of times with laws and regulations. An operational audit, that's where you're trying to see, is the company operating correctly? Are they doing the 3 E's, effectiveness, efficiency, economy? Are they doing the right thing correctly within the proper budget? So that's what we're trying to do. That's where we talk about an operational audit. Quite often, someone within the company called internal auditors, they may be doing these operational audits. So a friend of mine, for example, used to work at Arco, which is a gas company, huge company. So they would go out and he would go to different locations and he would see if that location is meeting, and this was a CPA exam question, are they meeting the organizational goals? Are they meeting the goals of the organization? So his job is to travel around to different places and do an audit of that location. Effective, efficiency, economy, the right thing correctly within the proper budget. It also says review by governmental auditors to determine the effectiveness and benefits of a specific government-funded program. That might be like the SAA, the Single Audit Act. So that's called operational. So both of these we're going to talk about down the road. What we're going to focus in on is what I kind of introduced you to. Introduce yourself. My name is, that's called a financial statement audit. What is that? It's an examination for the purpose of giving an objective, unbiased opinion. So it's an examination or an audit for the purpose of giving an objective opinion as to the fairness of financial statement presentations, and these presentations are the responsibility of management. Whose statements are these? Management's. Good job. Remember that? Management's. All right. So what is a financial statement audit? It is an examination or an audit for the purpose of giving an objective opinion. Objective means unbiased. Objective means neutral. Objective means clear mental attitude. It means you don't love the client, you don't hate the client, you're neutral. That's what we talk about with objective. So we'll talk and define objectivity. We're objective, unbiased, neutral. We're independent. That's going to be a key term in auditing. Independent, no direct financial interest, no material indirect, which we'll talk about later on. And we're giving an opinion. Now, our opinion does not say, in my opinion, these numbers are perfect, they're free from fault or error. No, we can't give that. Instead, we say, in my opinion, the statements are presented fairly in all material respects. That is based on a really important concept, that of reasonable assurance. And that's called reasonable versus absolute assurance. And here's how that works. With reasonable assurance, what we're doing is we're saying, okay, let's look at the company's transactions. Let's say $0 to $100 or 100% or 100 million, whatever. Here is all the transactions. We will determine some level of materiality, and we'll define it later on. Materiality basically means how important or how significant an amount is in relation to the whole picture. So, for example, what we're saying is it large enough to affect the user's decision? If this amount is significant enough to affect the users of the statements, that's material. So we have a material. So everything above that is considered part of what we're going to look at. Everything below that we're going to blow off as immaterial, 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 pass further review, appears reasonable, and in the real world, go to lunch early. Okay? But what we're saying is it significant? Who determines materiality? Auditor's judgment. Whose opinion is it? The auditor. Whose statements are these? Management's. Whose opinion is it? The auditors. So we determine how much work is enough. Everything above that level is called the scope of our audit. Everything below that so like a $3 item, for example. Is that important? Probably not. So with $3, we go, you know what? It's so insignificant, it won't materially affect the numbers or the user's decisions. Therefore, it's immaterial. Because if you wanted to look at every single transaction for any amount of money, it would take you forever to do a one-year audit. So that's why we say, okay, this is the scope. This we're going to blow off as immaterial. That's called reasonable versus what? Absolute assurance. Absolute assurance would be looking at everything. We don't want absolute. We want what, everybody? Reasonable. What is this based on? It's based on what we call the cost-benefit principle. Because the cost of auditing this $3 item outweighs any benefit derived from it. Because it costs you more, it's not worth it. Cost-benefit, also based on materiality. So we talk about these overriding constraints to usefulness, and we'll talk about the conceptual framework for accounting in the FAR exam, in financial accounting and reporting. So we'll talk about it there, and I'll define it for you in detail and so on. One of the things we'll talk about is what overrides the usefulness of information, subject to these constraints, cost, benefit, materiality. All right, so if you look in your notes, financial statement audits, examination or audit for the purpose of giving an objective opinion as to the fairness of financial statement presentations in all material respects that are free from material misstatement, whether due to error or fraud. We're going to use those terms a lot. Errors versus fraud versus non-compliance. Non-compliance being like illegal acts. In conformity with an applicable financial reporting framework. Now that term is relatively new. That came out because of the Clarity Project, which hit the exam starting in July of 2013. What it said is the Clarity Project, which I'll talk about in a few minutes, clarified a lot of these standards. And what it did is it went through all the auditing standards and it took your 10 generally accepted auditing standards and it rewrote all the standards. It put them in a whole different format. It put them into like an introduction, objective, definitions, requirements, and then how to apply it. So it went through and did that. One of the things it did is it also changed, instead of always saying in conformity with US GAAP, it became more broad and said in conformity with applicable financial reporting framework. So that is your applicable financial reporting framework, AFRF, which I'll be using again and again and again. applicable financial reporting framework. Because the applicable framework could be GAAP, it could be IFRS, it could be governmental auditing standards, it could be some kind of what we call a special purpose framework. So it could be whatever is applicable to the business. Part of your job as an auditor now is to make sure and evaluate the applicability of it. Did the client pick the right framework to use? So as we go through here, back to my definition, what is a financial statement audit? An examination or an audit for the purpose of giving an objective, unbiased opinion as to the fairness of what? Financial statement presentations. And the presentations to whom? To creditors and investors. Again, people who want to buy stock in the company, invest. People who want to loan money to the company and say, hey, are they financially sound? Will I get my money back? Will I get my interest on that? That is basically what we're going to spend most of the course talking about, what we call a financial statement audit. Now, when you look in your notes, it says, again, a financial reporting framework is a set of criteria used to determine measurement, recognition, presentation, and disclosure in all material items appearing in the statements. Two examples of an applicable financial reporting framework. The two are called a general purpose framework and a special purpose framework. So we have what we call general purpose and special purpose. So when we're giving an opinion, we say, in my opinion, it's presented in conformity with the applicable financial reporting framework. What are the choices? One is called general purpose. General purpose basically says it could be either GAAP, which is generally what we're using here in the U.S. It could be IFRS, International Financial Reporting Standards. It could be by GASB, Governmental Accounting Standards Board, which would be like a GAS audit, Governmental Auditing Standards audit. That's what general. Then we've got special purpose framework, which I'll talk about in another section. Here, that's kind of like your other basis of accounting. We used to call it OCBOA, other comprehensive basis of accounting. What are some examples of special purpose frameworks? You'll see in your notes cash basis, tax basis, regulatory agency basis, contractual basis, or some other basis of accounting. That's called special purpose. So when we go through and we're saying, in my opinion, the statements are presented fairly in conformity, not always anymore with U.S. GAAP, but with the applicable financial reporting framework. Learn these terms, applicable financial reporting framework. So if you took auditing before July 2013 or before, all you learned was U.S. GAAP. Moving forward, what is it? Moving forward forever and ever and ever? Or not ever and ever, but these were some significant changes, not even the last few years, but the last several decades for auditing, applicable financial reporting framework. Now, what should the auditor that's going to do the audit possess? They need to possess the appropriate qualifications. So we're going to talk about what makes you qualified. What do you think I need to be? I should be trained. I should be independent. I should have a clear mental attitude. I should be able to act with skill. So these are things I need. We also need to apply what we call professional skepticism. Now, what is professional skepticism? It says here an attitude that includes a questioning mind and a critical assessment of audit evidence. That's what we talk about with professional skepticism. So what that means is that as professional, you need to question and doubt everything. So when you go out to do an audit, you're going to go out and you're going to audit, for example, accounts receivable or inventory. And I'm going to go out and say, hey, client, I need sufficient, appropriate audit evidence to corroborate this change. And the client goes, God, I hate auditors, because they have to go and they have all their job to do, their regular work, plus they've got to give you all this extra information. I need this, I need this. So then when they give you the information, you go, how do I know this? How do I know that? But it's sufficient, appropriate audit evidence. So you're acting with professional skepticism, where when they give it to you, you don't just say, appears reasonable, pass further review and check it off. Instead, you ask, how do I know this? How do I know that? What does this number represent? Why did this change? Why did you write off this account receivable? Where did this sale come from? Where is the authorization? So you're asking a lot of questions. That's called professional skepticism. Again, a questioning mind and a critical assessment. That's what it is. The problem is, as an auditor, you come home to your happy home and you go, honey, I'm home. Honey, I missed you. How do I know you missed me? I need sufficient, appropriate audit evidence to corroborate the fact that that's called professional skepticism. All right? So the question is, did we all become auditors because we were skeptical, or did becoming an auditor create the skepticism? Good question. Thanks for coming out. All right, what else should the auditor possess? Complies with relevant ethical standards. So we'll talk about the ethical standards in the next section, where we want to make sure that you are ethical, you are independent, you're adhering to all these different the different bylaws and rules. Exercise professional judgment throughout the engagement. It says to express an opinion on the statements, the auditor obtains reasonable assurance as to whether or not the statements are free of material misstatement. Now, when we talk about reasonable assurance, that was this. Reasonable versus what? Absolute. Absolute, you look at everything. Reasonable assurance. So what we're going to do throughout the audit is we're going to go through and say, okay, here's what we need to do. And you'll see in your notes, to obtain the reasonable assurance, what do we need to do? Plan the work, supervise assistance, determine materiality levels, identify and assess risk and material misstatement, which we're going to use that term again and again, RMM, the risk of material misstatement, the risk that the assertions are materially misstated in the financial statements, RMM, and we need to obtain sufficient, appropriate audit evidence. Now you'll see again that picture here. This is the scope of our audit. This is below materiality. This is what we're not going to look at. We need reasonable assurance. So the thing that I want you to realize is, how does this all tie together? That's how we're doing an audit. How does an audit flow? First of all, we're going to go out and you'll see here, prepare for the audit. That's what we're going to talk about in this section where we're preparing for the audit. We want to make sure that we are prepared. We want to then decide, should we take the job? We decide to take the job. Let's sign a contract called an engagement letter. Let's start planning the job, planning procedures, planning considerations. Let's talk to the old predecessor auditor, the auditor who preceded us. And so we're going to go through all the detail. That's what we need to do in preparing. Then we need to obtain an understanding of the client's internal controls and the environment. Because whose statements are these? Management's. Whose internal control system is it? It's management's. So the internal controls, the results of that are these statements and the numbers within. So therefore, if internal control looks good, I can put more reliance on the numbers. I won't have to test as many of the dollars. If internal control doesn't exist, then I go, controls created the numbers. I don't know if the numbers are correct. I better do more testing. So in deciding that, I will look at what we call risk of material misstatements. And it says assess the risk of material misstatements and determine nature, time, and extent of further procedures. Then I'm going to perform my test of controls, testing internal control. Then I'm going to perform my substantive test to substantiate or corroborate the dollars. And what happens is, here's what I think materiality is going to be. When I look at internal control, I go, hey, controls look really good. This materiality level is fine. So let's say this is $1 million of receivables, $1 million. So maybe materiality is $10,000. Every receivable over $10,000 I'm going to look at. Everything below 10 I'm not. But let's say instead internal control doesn't look good. Let's say reliance on internal control is bad. So I go out there and I say, before you make a sale, do you check people's credit? And they go, never thought about that. That would have been a good idea. Okay. Hey, before you make the sale, do you make sure you have the inventory on hand so you don't agree to sell stuff and then breach the contract? Never thought about that. So these are all questions. So if they're saying no, 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 I don't do any of that, that's a problem. So what's happening is reliance is low, therefore I better do more substantive testing. That means I'm going to do more testing of the dollars of, for example, receivables. If that's the case, then I better take materiality and decrease it to maybe $5,000. What did that just do to my scope prime? It increased it. So if reliance is low, more substantive testing. If reliance is high, less substantive testing. So that's what we're looking at where it talks about TFC, then perform substantive testing, formulate an opinion, and then what? Issue the audit report. Here's your audit report. In my opinion, the statements referred to above presents fairly, in all material respects, the financial position of Exxon with 1230 was on the results of its operations in conformity with the applicable financial reporting framework. Lovely. So that's what we're looking at as the basic types of audits. So it's important to understand the basics, again, of what we're doing and why we're trying to do it.